Adrian, what Chief Asian Emerging Market and Asian Equity Strategist for JP Morgan joins us live. Adrian, good morning. Thank you for joining us. Adrian, a lot of price damage has already happened in Indian stocks, and you have downgraded your India rating to neutral. Some would argue that it's too late to downgrade now.
Look, I think you make a fair point, and you always hate having to downgrade things after there's already been weakness. The problem that we have at this point in time is it's difficult to identify what is going to stabilize the currency. And we are moving into a high-risk environment with the Fed starting tapering in September. So the overweight was not working. We could have swung this all the way around to an underweight. And maybe one of the arguments for not doing that is there is long-term value emerging in Indian equities. But I think the short-term tactical issue is still further downside in emerging market equities, emerging market currencies. And India, with its current account deficit that will be somewhere between 4 and 5% of GDP this year, is more vulnerable than other emerging markets. It therefore doesn't make much sense to have it as an overweight.
Adrian, in the near term, what's the biggest risk when it comes to markets like India? And would you attribute that to the currency weakness? Because just yesterday, we've seen the INR breach the 63 mark too.
Yeah, look, it's three problems: the rupee, and the rupee, right? This is all about the currency. If you were telling me that the rupee would trade back to between 61 and 62 and stay there, I would be buying this market. But I think the risk at the moment is that you will see outflows from emerging market fixed income funds. You will see redemptions for EM equity funds. You will see allocation away from India, and the pressure will continue.
Adrian, some would argue that India's economic problems are well documented and nothing has changed in last 1 week. And even though fundamentally and economically nothing has changed in last 1 week, bond yields have gone up, rupee has cracked, and equity markets have been in some kind of a tailspin. So do you think more than absolute economic news, it is the perception and sentiment which has changed?
Look, something has changed here, which is the currency has continued to slide significantly. And India, India's run a current account and a fiscal deficit ever since I started investing in it back in '93. So I would agree that the scenery hasn't changed for India, nor has it necessarily changed for Indonesia or Brazil. But what has changed is since May this year, bond markets have been weakening. So when we had quantitative easing, before we had the mention of tapering, current account deficit countries found it a very easy environment to fund those deficits. The environment has become harder for funding those deficits, and you've moved into what is a little bit of a vicious spiral, whereas currencies have weakened, the policy actions in themselves can undermine the growth story. And for India, as opposed to Brazil and Indonesia, India is more dependent on equity capital flows than fixed income flows. If you are dependent on fixed income flows, raising interest rates can be the solution. If we raise interest rates in India and slow down growth, it becomes less of an attractive story for the equity investor, and that could compound the problem.
Adrian, let's chat sectors and want to talk about the banking pack. Considering your views on banks, do you think there is more pain in the Indian banking sector, or is the risk-reward ratio now favorable, and perhaps you would recommend to investors that they should start to nibble into the space?
I think that the answer to that question depends on investors' time horizon. If you have a 1 to 3 year view then there are Indian banking franchises trading at price to books that we have not seen for many years, maybe going back to 2008. And if you can wear the volatility and the pain that you might experience through September, then yes, I think you should be looking at the value opportunities there. If you have a more short-term horizon, then I think you need to focus on the currency.
Adrian, do you think the big risk for Indian equities is technicals and over-ownership? India pretty much has been the market of choice for a lot of global equity investors. But now, once the money outflow has started moving away from emerging markets, an over-owned market like India could suffer the most?
India is, when we look at the active large emerging market funds, India is the consensus overweight. It is underperforming. The pressure is on fund managers to reduce their overweight, just as the pressure was on me to reduce my overweight.
Right, Adrian. Really appreciate your time and thank you for your insights.